Welcome to the PlanStrongerTV market update for Wednesday, December 10th. Let's take a quick look at the markets. And a new feature we're doing here is we're giving you the 3-year return. So there are your total return for the entire 3-year period, cumulative, not by year. So you can see that. Now, if you want, of course, you can pause the video and you can divide by 3 to get your returns as an average for the 3-year period per year. But we're putting that as context or a backdrop because of how strong the market has been in 2024. You'll see that. And then you'll also look at where we are year to date, which of course is what we're focused on. Your year-to-date numbers, strong across the board on those indices that we talk about. Continuing to have a standout with the foreign stocks nearly double in some cases versus the US-based focused stock indexes we're tracking. And then bonds still having some decent appreciation. You see there with the 6.72% year-to-date. And so that's the context. We're going to go to Robert and talk about some job opening data. And now that we got that data flowing from the government and also inflation expectations. So the labor market, Robert, is really where I think things are coming into focus now as we're looking at inflation and whether the Federal Reserve is going to really follow through on the expectations of a rate cut here in December. There's a lot here. Let's start with the jobs numbers. The job market is supposed to kind of be the Achilles heel right now of you've heard us say, okay, weakening job numbers here. The other pundits on TV, the labor market is softening. Well, the job opening and labor turnover survey, we got 2 months worth of data yesterday. We got September and we also got October. So from the September number came in at, for the number of job openings, 7.658 million, David. And that is 431,000 more than the August number. So a huge increase in job openings, which is fantastic. And then the October number, 12,000 more than the September number. So wait a minute, I thought demand is supposed to be weakening and, that sort of thing. Manufacturers and retailers, they don't, hire, they don't put in open positions when the economy is supposedly, weakening, or at least the labor market is weakening. Now, I will add as a caveat, we are going into the holidays, of course, so a lot of those are those seasonal, to fill the seasonal openings. But, the data indicates that it's not just the seasonal workers that are being hired or that companies want to hire for. So, you hear oh my gosh, the labor market's weakening, but it's a positive sign with the JOLTS report that came out yesterday. Well, when you say, Robert, we hear that, it's being said that, we're referring to the media talking about what's going on. And, it's always the same thing, look at the data. Now that we have data, we can, actually look at what's actually happened. As Robert shared, those are positive things. So, and then on the other hand, how strong the economy is and whether it needs a jolt, no pun intended, will be a function of those things. And of course, the market has priced in. What's the probability now for a rate cut of at least 0.25% for December?
This morning, it was 89.9%. So basically 90% of a rate cut today.
Now, the Fed is signaling its next step already by saying, well, if we cut, then we're going to, maybe raise the bar or there may be a higher hurdle to get over. In other words, the news would need to be more significantly worse. There would need to be some erosion of the strength of the economy for them to then want to raise rates more. So the way I take that, Robert, and you can give your opinion, is basically the Federal Reserve's like, all right, we'll give you your 1/4 point, but don't ask for any more for a while.
You know what? David did not read my notes, and he just completely stole my thunder. So thank you, David.
You're welcome.
And I mean that sarcastically. No, he hit it right on point with what I want to say. What I wanted to
Which he's going to say anyway. Go ahead.
I'm going to say it anyway. So, our viewers might be like, hey, great, another lower borrowing costs for 2026. But expect
Mr. Jerome Powell, the Fed chair, at the news conference today say exactly what David said. Hey, we're cutting, but for 2026, we're going to slow down. The JOLTS numbers were strong. The job market isn't as weak. So, paradoxically, ironically, I'm not saying this is going to happen. I don't have a crystal ball, but if I do, it doesn't work. If you're expecting the markets to go up today after the news conference at 2:30, 3 o'clock, you might see plummeting markets based on what Mr. Powell says. So you hit it right on the head, David, that yes, most likely we're going to have a rate cut, but then come the setting up of expectations for 2026, which is what the markets are really focusing on.
And I think with what the market's focusing on, the markets are always looking beyond the next step because they've already priced in, they being the broader market, the consensus of investors buying and selling has already priced in this rate cut. It really has at 90% probability. So if we don't get the rate cut, you can expect the market to come down some. It's not the end of the world. It's just priced into the numbers. And then, as Robert said very well, I would put it at an equal focus, not just on what the Federal Reserve says or what it does, but what it actually says about what's going forward. So they're going to do this and the market responds, but then what they say is going to happen is equally considered because that's going to drive the market longer term.
Exactly.
Yeah. Okay, good. All right. So anything else about inflation?
Yes, about inflation expectations. So we talked about the jobs numbers, at least with the job openings, that, they're hires. Good news. Another bit of good news long term for the past, kind of since the beginning of April's Liberation Day tariffs, are inflation expectations. A lot of the media said inflation is going to skyrocket. Expectations went through the roof, which is why we've had a lot of volatility and some pullbacks this year. But those inflation expectations soared to about 6.1 or 6.4% in May, I believe. Then they came down to 5. Now they're at about 4.1%. They've plummeted at least 2.3% or so, and they're continuing, the momentum is downwards. So kind of to take a step back, people listen to the news and about jobs and about inflation expectations that tariffs are going to explode. That simply has not happened. In fact, the antithesis has happened. So kind of the moral of the story is kind of keep things in perspective, listen to different segments of the media, step back, do your own research, listen to different commentary. Of course, there's going to be volatility. Of course, there's going to be pullbacks. I think we had a healthy pullback in AI and tech stocks recently. I think that was a healthy pullback. But one last thing I'll say, David, is that we still have a lot of cash on the sidelines. So I think it would be perhaps foolish to listen to one narrative and say, okay, I'm going to go all the way conservative when, even though I have time on my side and I could be in growth or growthier equities and stocks, just keep your head about you, look at the data, analyze the data, listen to different opinions, because you listen to one and you get stuck in this universe of doom and gloom. It just doesn't help one's portfolio at all.
No, it doesn't. You've got to be as objective as you can. And I think what, Robert's kind of final comment there is really important to double underline. And it's that, we're going to have pull downs and pullbacks. Again, anywhere between 1% to 5% a pullback. So from where the market's been. So there are people on the sidelines who are professional investors who have a lot of cash sitting there that they need to deploy. And they're waiting for the market to go down. When other people are getting out, they're like, outstanding, I'm getting at a discount. The more the market goes down, the more they push that cash in. So it goes down 5, certain amount goes in, it goes down 10, they're putting money in. Because again, as the market is reacting to whatever's going on, there are 2 different people for every transaction saying, I'm selling, I'm scared, I'm worried. Somebody else saying, I'm bullish, I'm looking longer term. This is a buying opportunity. So just keep some of that in perspective. Any final thoughts?
No, I think you hit it on the head, David.
All right. Well, we'll continue to try to hit it on the head and monitor the situation for you. And we'll be back and we'll talk more about all of the things going on with the market and other financial topics, help you continue to plan stronger.